Getting a perspective as to what the outlook is on emerging markets as a whole in light of the geopolitical risks and whether or not the $5 trillion goal is too ambitious. We've got Bill Maldonado, who is Global CIO Equities in Asia, joining in from HSBC Global Asset Management. Bill, lovely to have you on board. Now, the markets have reacted quite negatively earlier or last week due to the US-Iran tensions, but now we seem to have settled down, quoting at those fresh lifetime highs after we've got some sort of a reassurance from both the countries that maybe as of now there is no war-like situation on ground. Do you think that the worries are now completely over? There's not going to be any further action by the countries, or we're still a long way off?
Well, look, these geopolitical situations are very difficult to predict. So in this particular case, it's simply very, very hard to say. What I would say is that history teaches us that these situations are much less impactful to the global economy than it seems that they could be at the time that they're happening. If you look at a chart of the market, it's very difficult to see on that chart even very major things like the Iraq war or the 9/11 terrorist attacks or things like that. So of course they're terrible events, and of course it feels extremely uncomfortable at the time, but they tend to be much less impactful. And certainly from an investor's point of view, it's very difficult to drive an investment portfolio based on macro analysis of those kinds of situations. So we hope that this situation has calmed down now. We hope it's not going to be a drag on the market. We don't know, but that's certainly what it looks like at the moment.
All right. Last year belonged to the developed world, Bill, while emerging markets underperformed. Do you see that reversing in 2020?
Yeah, look, this is a great question. And I think it's worth thinking about why would people prefer developed market US exposure versus emerging markets. And I think the answer is uncertainty and fear. And when people are very fearful and they're very risk averse and there's a lot of uncertainty in the global economy, then people are more likely to prefer more predictable, safer investments, more predictable earnings, more stable economies, and the US is kind of right at the center of all that. So we can understand in many ways why that turned out that way last year. Now, as people become less risk averse and more interested in finding growth, more growth seeking, then that growth is not in the United States or in other developed economies. That growth is in emerging markets, particularly here in Asia, across Asia, in China, in India, and other parts of the Eastern landscape.
Current stance on Indian equities, any pockets of the market that you believe for the long term, say a 3 to 5 year horizon, look attractive?
Yes, so look, we're very positive on Indian equities. I know they look a bit expensive relative to their own history, but relative to Asia or other emerging markets, they don't look particularly expensive. They look about neutral, really. But the prospects in India are very high, are very strong. So we're expecting very big earnings growth in FY20 and 21, maybe as high as 20% plus. That's very strong compared to the rest of the world. And we see the reform agenda continuing in India. It's one of the countries that has the strongest and clearest reform agenda. So there's a lot of positives to the Indian market. I know that Indian domestic investors are quite concerned. I know that they wish that GDP growth was higher, and I can understand that partly. You know, the potential in the economy here is very high. Earnings could the economy could easily be growing at 7% rather than 5%. But again, relative to the rest of the world, that level of economic growth doesn't look too bad. So I think international investors are very interested in India. I think there's a lot of positives, and I think the potential is very high. So I think it would be a very good investment for an international player for 2020 and beyond.
Thank you so much for joining us, Bill, and sharing with us a little bit on, where you see Indian equities currently.